Welcome to the Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Would you jump off a cliff just because everybody else did it? That was one of my mom's favorite retorts whenever I would tell her everybody's doing it, hoping to get her to give me permission to engage in this or that activity. And I got to tell you, it drove me crazy at the time when she would say that. But as I grew older, I realized that, she was really just trying to drive home the danger of always following the crowd. Now, I think a lot of people out there in the investment world would probably do well to consider my mom's sage wisdom, because I'll tell you what, there's a lot of follow the leader sentiment out there in the marketplace. You've probably heard the term FOMO bandied about. It stands for fear of missing out, FOMO. And, it drives more than its fair share of investment decisions. The term is usually applied to buying like a stock or another asset because everybody else has jumped on the bandwagon. And I think there's a good bit of FOMO sentiment out there in the Bitcoin world right now. Now, I'm not necessarily saying that it's a bad thing, but it's definitely a thing. But, the term FOMO could also apply to selling. And over the last few weeks, a lot of people have been selling gold, and we've seen this in the downward pressure on the price. I think the FOMO sentiment might be driving at least some of this selling action in the gold market. Because if you step back and look at things objectively, well, it really doesn't make much sense. But before I get into the gold market dynamics, I want to touch on an important economic principle that seems to be lost on a lot of people right now, and that's scarcity. Now, scarcity is one of the most fundamental pillars of economic thought. It's like the foundation of economics. Human beings have unlimited wants and needs, but we are faced with the problem of limited resources. And this leads to an unpleasant but unavoidable reality. We can't have everything we want. And this is true. I don't care how rich you are, right? I guarantee you that there are things that Elon Musk would love to have or do that he simply can't afford, or he doesn't feel like he could afford, or he'd have to sacrifice something else. Because no matter how much we have, we could always have more. We always want more. And, I've seen this in my own life. I remember when I was young, I would think to myself, well, if I just had $30,000 a year, I could live like a king. Well, you get to $30,000 a year and all of a sudden you realize that's not enough because you want more. You have new needs. You have more needs. And so this is just a reality that we live in. And it really is kind of the foundation of what economics is trying to deal with. How to allocate limited resources to unlimited wants and needs. And what's got me thinking about this is the recent murder of United Healthcare CEO Brian Thompson. And I got to tell you, there is a disturbingly large number of people out there who seem to think that killing this husband and father was somehow justified because the insurance company that he runs denies claims. Now, look, I'm not here to defend United Healthcare policies. I honestly don't know enough about them to even do so if I wanted to. And it wouldn't surprise me if they're pretty crappy policies. In my life, I've dealt with some unpleasant issues with insurance companies. But I do need to point out that in a world of scarcity, every person isn't going to get every healthcare procedure that they need. No, it's not fair, but it's reality. There aren't enough doctors, medicines, hospitals, technologies, etc., for everybody to get every treatment that they need at an, quote, affordable cost. Healthcare is going to be rationed in a world of scarcity. Insurance companies ration healthcare by denying claims. Government healthcare systems, which, by the way, are not free, they ration healthcare with long lines and by outright denial of treatments. I don't care what healthcare system you point at, whether it's the U.S. system or the British system or the Canadian system, they all ration healthcare because there isn't enough healthcare to go along. It doesn't matter what system you build, it will never satisfy all of the needs. Now, please hear me when I say this. I am not defending the U.S. healthcare system. It sucks in a lot of ways. And oh, by the way, a lot of the suckage is because of government intervention. A lot of healthcare pricing in the U.S. is set by the government. Medicare and Medicaid together account for about 40% of all U.S. healthcare spending. And so that big thumb on the market, it kind of sets prices. I mean, it's just a reality. So please stop calling this a free market system. It's not. It is effectively a government system with some elements of free market and a bunch of corporatism stacked on top of it. But anyway, between its pricing power and all of the regulations Obamacare imposed on the insurance industry, prices are far higher than they would be in an actual free market. In fact, it's interesting. If you look at less regulated aspects of our healthcare system or areas that are less bound up in insurance, things like LASIK surgery or cosmetic surgery, prices are a lot lower. I mean, I can give you an example just from me recently. I'm dealing with a knee problem because I'm 57 and insist on playing ice hockey. And so I went to an imaging service as the cash payer, and I got an MRI for $300. I mean, the very fact that MRI technology exists, that they can look inside of my knee, is freaking amazing. But the fact that they can do this for $300, even more amazing, right? Kind of mind-boggling if you really stop and think about it. If you think about the advancement in medical care, taking all of the, the insurance and the money stuff out of it, just the things that they can do. The fact of the matter is I have an artificial heart valve, and if I had been born, 50 years earlier, I'd probably be dead by now. But because they've advanced to the point that they can stick an artificial heart valve inside your heart, I'm alive and kicking today, still playing hockey and able to hurt my knee. So, yeah, it's pretty amazing. But I'm getting away from my point, which is the fact that there is scarcity. There is always scarcity, and there's always going to be scarcity. And, I think in America in particular, we're kind of insulated from this harsh reality because, we have a lot. The poor in this country have a far higher standard of living than royalty had in the Middle Ages. And please, again, I'm not trying to, downplay the pain and the difficulty of poverty. I'm just stating this fact that overall, human beings have a much higher standard of living than we did 200, 300, 1,000 years ago. And it's because of the advancement of technology. And think about this. Most everybody, even poor people, have a phone in their pocket that has more computing power than was used to go to the freaking moon. But that abundance doesn't mean that there isn't scarcity, right? Nobody gets all they want, as I just said. And it's not really about money. In fact, it's really not about money at all because money is just a means of transaction. It's really about stuff. There isn't enough steel, oil, plastic, wood, labor, you name it. There's not enough of it to do everything that people would want done with it. So given the reality of scarcity, the real issue is distributing those scarce resources in the most productive manner so the most people get the most of what they need and want as possible. And that leads to another reality. There are really only two ways to distribute scarce resources. We can distribute them through free markets that are driven by a pricing system that helps allocate resources based on price, or we can allocate resources through central planning, and that's driven by politics. Now, if you look at it objectively, when it comes to allocating scarce resources in the most productive way possible, the most efficient way possible, markets will win every single time. No, they are not perfect. There will still be, misallocations. There'll still be problems. But markets are far better than central planners because there is no brain trust that can figure out what resources need to be allocated to what purposes. There's no group of human beings that can rank needs and wants, because another fundamental economic reality is needs and wants are subjective. We're all different. We all have different wants and needs. Value is subjective. So there's not a brain trust that can allocate resources to certain purposes. I talked about on this show the knowledge problem. Friedrich Hayek, to pronounce it properly, he laid out this knowledge problem. And basically, what I'm getting at is that no person or group of people can obtain or have or process or possess all of the information that's necessary to make good decisions. There's no purpose or there's no person or group of people that can foreknow all of the consequences of a given decision. There are always unseen consequences when people make a decision. And then when you throw politics into the mix, well, then it gets really ugly, right? Because we all know that politics generally poisons everything. Markets with a free pricing system do a much better job because all they are essentially is the total of millions and millions of decision makers acting in concert. It's the animation of Adam Smith's invisible hand. And again, not perfect. There is no perfection unless we can solve scarcity. And we can't solve scarcity because the moment we do, somebody will come up with another want or need. And, in my view, the problem with the American healthcare system isn't that it's too free market. No, the problem is it's not really free market at all. You've got bureaucrats and politicians and insurance people setting prices without any type of real price competition. I mean, no wonder it's a hot mess. We need more free market. But even at that, and this is really the crux of my point, we always have to reckon with scarcity. And, I had a guy the other day, smart dude, guy I respect, try to tell me that no, there's no such thing as scarcity. We have all that we need. No, we don't. That's absolute bunk. It's an illusion. There will always be scarcity. And so we have to reckon with that, and we have to figure out the best way to allocate these limited resources. And again, that's through the free market. So that's my rant on that. Let's talk about gold. I mentioned on the top of the show that there has been a good bit of selling of late in the gold market. And of course, I talked about last week how we had the Trump shock, and that caused a bit of a sell-off. And then we had a rally. We actually had gold back above $2,700 an ounce. And then we had more selling. And this was primarily driven by inflation worries. First, we got the CPI, which was, as expected, it wasn't good, but it came in basically where people thought it came in. And I thought that was interesting because we didn't really see much movement in the price of gold based on the CPI report. Everybody seemed to think, well, it's bad, but that's what we expected, so no worries. But then we got the producer price index, and it came out, I think it was on Friday last week, and it was way hotter than expected. In fact, it was a pretty bad PPI report. And so with inflation worries mounting, investors sold gold. Whoa, wait. People sold an inflation hedge with increasing signs of inflation? you heard me correctly. We've returned to this kind of bizarro market dynamic that really dominated 2023. Investors worried about sticky inflation or dumping gold, an asset that has traditionally served as a hedge against price inflation. Now, is this a mistake? Well, yeah, I think it is, and I'm going to explain why. The reason people keep dumping gold every time we get hotter than expected inflation is simple. Mainstream investors think the Federal Reserve might cut interest rates more slowly than anticipated. And since gold is a non-yielding asset, right, it doesn't pay interest, it tends to hit headwinds in a higher interest rate environment. So they're spurning the yellow metal. And again, we saw that over and over again in 2023. You would get a hotter than expected inflation report, people would sell gold because, oh no, the Fed's not going to start cutting. And you'd get bad economic data and people would buy gold because, oh, now the Fed can cut. But if we got good economic data, well, then people sold gold. It was kind of this counterintuitive, weird kind of thing. And again, on the surface, this strategy kind of makes sense, right? At least as a short-term play. But these mainstream investors are missing the bigger picture. Specifically, I think they're missing two very important factors. Number one, inflation isn't likely going anywhere anytime soon. And I think a lot of people think it is. I think the Fed's going to beat it down. And number two, the Fed is going to keep cutting interest rates. So let's take these two factors one at a time. We'll start with inflation, not going anywhere. And the data is telling us this. It's been telling us this for a while, but I think a lot of people are under this illusion that, oh, the Fed's got this under control. As I mentioned, the PPI came in really hot. In fact, if you're worried about inflation, it was a pretty awful report. Producer prices rose 3% on an annual basis last month. That was up from 2.4% in October. It was the highest year-on-year increase in producer prices since February of 2023, so well over a year ago. On a monthly basis, PPI was up 0.4%, and that compared to a 0.2% rise in October, so basically doubling. Surging producer prices are particularly worrisome if you care about inflation because they are generally leading indicators for consumer price inflation. I mean, just think about what producer prices really are, right? The PPI calculates the prices that producers are paying for their production inputs. It's basically their costs. And at least some of these price increases, some of these costs, are going to get passed along to consumers in the future. And that's going to drive the consumer price index higher. So you get higher producer prices first, companies adjust, they raise prices, and then that pushes the CPI higher. And I mean, let's be honest, the CPI data is already worrisome, right? The core CPI, when you strip out the more volatile energy and food prices, it's been mired around 3% for months. We really haven't seen it budge in quite a long time. But, I mean, how can this be, right? I mean, the Fed beat inflation. That's why it's gone back to rate cuts, right? Well, yeah, that's the story, but let's be honest, it's pure fantasy. As I've pointed out over and over again on this show, the Fed's inflation fight was wimpy compared to the inflation it created during the COVID era. On top of that, the Fed never did unwind the inflation that it created in the decade following the 2008 financial crisis. And I think it's interesting to replay what happened in 2008, right? When Ben Bernanke started quantitative easing, he started that money printing program, buying bonds, creating money out of thin air, injecting it into the economy. He swore that it was a temporary emergency measure. He swore that the Fed was not monetizing debt and that once the crisis had passed, then the Fed was going to unwind all of this easy monetary policy that it was ramping up. Never happened. I mean, we went 10 years almost at 0% interest rates. And when the Fed finally did get around to raising interest rates and starting to get some of that money off of its balance sheet. It didn't last very long because in the fall of 2018, we had a big crash in the stock market. The economy started getting wobbly, and the Fed immediately abandoned balance sheet reduction and started cutting interest rates again. So, Ben Bernanke, you can look at it one way or another. He was either wildly wrong or he was lying. But the fact of the matter is, most of the inflation that was created during the Great Recession is still out there in the economy. And then they doubled down on it during the COVID era. So the Fed has not done enough to address this inflation. And then it surrendered to inflation last summer when it announced plans to slow balance sheet reduction. Simply put, raising interest rates to 5.5%, coupled with a modest decrease in the balance sheet, was never going to unwind the inflationary impact of nearly $9 trillion in money creation. That's combining Great Recession and pandemic, and then well over a decade of artificially low interest rates. Remember, Paul Volcker had to jack interest rates up to 20% to slay the inflation dragon back in the 1970s. Powell and company essentially shot some BBs at inflation, and then he packed up and called it a day. And this is why I'm convinced that price inflation isn't going anywhere, because the inflation that created the rising prices is still there. The Fed did just enough to create an illusion of victory, to kind of paper over the problem. But as I wrote in an article a while back, the inflation monster is still hiding under the bed. So the Fed is meeting today, and, given this bad inflation news, well, they're probably going to raise interest rates, right? Nope. Oh, well, they're going to at least pause rate cuts for now, right? Nope, probably not. Now, everybody seems convinced that they're going to get another quarter-point rate cut today. So how does any of this make sense? Well, it doesn't. I mean, not in a sane world, but the fact of the matter is we don't live in a sane world. So why is the Fed easing monetary policy when it's clear that price inflation is alive and well? Well, it's because they're never going to say the quiet part out loud. But the central bankers at the Fed know that this debt-riddled bubble economy can't function in a higher interest rate environment. The economy is addicted to easy money, inflation, and the drug pusher is giving the addict more drugs to keep it from going into withdrawal. It's as simple as that. Now, I know you regular listeners to the show have heard me talk about this over and over again, but I don't think I can say it enough because, quite frankly, most people just don't get it. But look, decades of easy money has consequences, right? You take drugs, it has consequences. In fact, the easy money is what broke the economy to begin with. When things crash, you're going to hear a lot of people blaming the rate hikes, or they're going to say they left interest rates too high for too long. But that was just the rate hikes. It was just the straw cracking the camel's back. The real damage was done by all of the easy money that I've already talked about. Now we've got an economy that just can't function without it. It needs that drug just like the heroin addict needs the heroin. And the Fed took it away when price inflation got out of control because it had no choice, right? I mean, it was manifesting in the inflation. It's just like a drug addict, right? You have problems when you're addicted to drugs, but you also have problems when you go off the drugs. And we know exactly what happens when you cut an addict off from her drug habit, right? Bad things happen. You want examples? Well, okay, just consider the national debt. It eclipsed $36 trillion last month. The interest expense during fiscal 2024 was over $1 trillion. And this is just one example of how higher interest rates are putting a stranglehold on the economy. It's addicted to the easy money because the easy money facilitated all of the debt. The federal government isn't the only one struggling with debt. Corporate debt is at record levels. Consumer debt is at record levels. Everybody is levered to the hilt. And this economy is built on debt. The foundation is going to crumble if interest rates remain even modestly high. But keep in mind, it was the low interest rates, the artificially low interest rates, that facilitated the debt to begin with. If we hadn't had a decade plus of 0% interest rates, I guarantee you the federal government would have had a lot more trouble running up the national debt to the extent that it has. Easy money facilitates debt. It also creates a lot of malinvestments and misinvestments and problems in the economy that will start to manifest at some point. So the bottom line here is the Federal Reserve is walking a tightrope. It's trying to keep inflation under control. And it's also trying to not cause a major economic crisis because interest rates are too high. And the odds are this balancing act is going to end in disaster because it can't do it. It can't balance. It's not going to make it all the way along that tightrope without falling down. So when the economy visibly cracks, and it's going to happen, the Fed is going to be forced to get even more aggressive in loosening monetary policy. And if history is any indication, it's going to cut rates back to zero again. It's going to launch more rounds of quantitative easing, and that's a fancy term for money printing. We're going to go right back to the easy money policies that got us where we are to begin with. And if you think inflation is bad now, just wait until the central bank revs up the money printing press again. In my view, the most likely scenario down the road is stagflation. We're talking a crashing economy in the midst of rapidly rising prices. But, maybe we'll get lucky. Maybe we'll just have the crashing economy and prices will stay the same, which are, quite frankly, still too high. But there's a lot of people out there that believe everything is fine. I mean, after all, the Fed started raising interest rates over a year ago and nothing bad has happened. And now the central bank is cutting rates, so it's fine, right? According to most mainstream analysts, we're gliding into the soft landing. The Fed's got inflation under control, and we're getting some hot inflation prints and some bad CPI numbers, but overall it's okay. The Fed's got this under control and the economy is strong, it's growing. But it's important to not forget that if we go back to 2007, December 2007, the Fed was cutting interest rates. In December 2007, everybody was looking at the data and saying, hey, the economy's growing, the economy's strong. Everybody swore everything was fine. The subprime market, there were some problems in subprime housing, but it's okay. We've got it handled. Everything's fine. And then it wasn't. I've been saying for months that this looks a lot like 2007 2.0. And it's interesting because we're starting to see some people in the mainstream picking up on the similarities between today and 2007. Golden Coast consultant chief market strategist Gregory Kennan recently noted that in December 2007, quote, the stock market was near or at its highs as the economy was still growing, and the Fed decided to cut rates by 0.25% to 4.25%, while stating that inflation was still a bit of a concern. Man, that sounds familiar, right? As the saying goes, things tend to happen slowly and then all at once. We saw it in 2008, right? We got to the end of 2008, and even though everything was fine, just a few months earlier, everything suddenly fell apart and crashed. There's also some interesting similarities between today and the dot-com bubble. I was just looking at some of the stock market data. We had multiple days of Dow Jones losses. At the same time, we had the NASDAQ reaching new highs. Everybody's kind of pivoting into these tech stocks, and we're seeing this big tech bubble again. Looks a lot like the dot-com era. In fact, I saw a post the other day that pointed out that the NASDAQ is getting very close to those dot-com highs. And I'm talking about in real terms here. So again, things happen slowly and then they happen all at once. So, if you're thinking about selling gold and you're thinking, maybe the bull run is over and, we're seeing everybody else is selling and we're seeing some big losses and some sideways trading, maybe you ought to rethink it. I mean, look past the next month or two, right? Look 6, 12, 18 months down the road. You might just want to think twice about dumping your gold along with the masses, right? Don't jump off a cliff just because everybody else is doing it. And, in fact, you might want to consider these dips as buying opportunities. And if you're kind of thinking that, well, now is a great time to talk to a money metals, precious metal specialist. You just call 800-800-1865 and chat with these folks. Also, we're a week away from Christmas. Gold, silver, great idea for a gift. If you're wondering, what do I get that special someone? Get them the gift of gold and silver. We have all kinds of really cool products. You don't have to just get a golden eagle or something. There's a lot of cool things out there that are, they have aesthetic and sentimental kind of value. And yet also will retain their value because that's what gold and silver do. So talk to a money metals, precious metals specialist today, 800-800-1865. If you don't want to talk to somebody on the phone, you can go to moneymetals.com. You can chat online if you have questions, need advice, or you can just buy products directly from our website. So make sure you do that today. So that is a wrap for this episode of the Money Metals Midweek Memo. It's kind of a momentous occasion. It is the 50th episode of this podcast. How about that? Anyway, you can get more information about things I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up to get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do that, you'll also be able to listen to our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver, economics, and investing. There is going to be no podcast for the next 2 weeks because both of the Wednesdays are holidays. We've got Christmas and New Year's, so you're going to get a little break from hearing my voice, but I will be back in the new year. I really appreciate you listening to the show, and I hope you have a fantastic holiday and enjoy the rest of your week.